Capital markets are increasingly accounting for what we call ESG data, environmental, social, and governance data, the way that we measure a company's sustainability efforts. And in recent years, there is a proliferation of information intermediaries that rate and rank companies across these dimensions. We also have evidence that this kind of data is increasingly used into valuations of companies, into how the investment community is assessing and evaluating companies, but also in the way that analyst recommendations are being made by the investor community. Now, the interesting thing when we consider capital markets is that attitudes have changed over time. For example, in some research that I have done with George Serafim, we show that in the early 90s, companies that were performing well on sustainability were penalized by the analysts. So that essentially, although some people might think that analysts have been indifferent, we did find that the perception was negative. In other words, if you're a company that performs well, you're more likely to be faced with pessimistic recommendations by the analyst community. Now, why was the case? Well, because we had a frame of mind that was different than what we have today. We had the primacy of shareholder value creation. So if you're an analyst and you see a company that engages on socio-environmental issues, what do you think? Essentially, you think that the company is wasting shareholder resources by addressing these socio-environmental issues that are not important. However, of course, given the recent mega trends, given the size of the companies increasing, given the fact that these are becoming risks as well as opportunities, those socio-environmental issues are no longer regarded as distracting from shareholder wealth, but rather they contribute towards shareholder wealth. So what we saw in the capital markets is that those pessimistic recommendations increasingly decreased, and in even more years they became more optimistic. That tells us that the public markets and the analysts in particular have adopted a stakeholder perspective, understanding that the company needs to manage not only the economic context, but it's also its broader socio-environmental context, and they're essentially rewarding the companies that are doing that well. In other words, companies that perform well on the ESG dimensions. We also have evidence for more broader implications for the capital markets. For example, we know that not only analysts, but in general, the access to finance is improved for companies that have superior sustainability performance. Why that's the case? Well, for two main reasons. Companies with better sustainability performance are typically more transparent companies, so they provide more and better information to the market. And at the same time, these are companies that more meaningfully engage with their stakeholders. In other words, they have better contracting. So from a capital markets perspective, well, lower informational asymmetry and better contracting means better access to finance. And finally, there's a question of, well, how sophisticated are the markets in terms of assessing these policies? And what we're seeing in a subsequent paper with Olga Hahn is that, well, of course, the set of CSR policies or sustainability policies that you adopt are correlated with your performance. However, if we go deeper and we distinguish between externally focused versus internally focused sustainability policies, we see that the larger the gap between what's shown externally versus what's done internally, the bigger the negative impact on market valuation. In other words, yes, of course, the markets see the sustainability initiative as a whole, but they can also distinguish between the types of initiatives that the company undertakes. In other words, there is such a thing as a gap between what you say and what you do, or what you commit to do and what you actually are doing, and if that gap is large, the capital markets are going to detect that. So there's a set of evidence that tells us a lot about how increasingly capital markets are evaluating, perceiving all the sustainability integration initiatives. And in even more recent years, we begin to understand how this process plays out in the private equity space, a space in which capital providers do not face the immediate short-term pressures that we see in the public markets, a space in which investors might have a 2, 3, 4, 5 year horizon and to make appropriate interventions to the portfolio companies towards sustainability. And there we see a lot of interest by private equity companies in these ESG issues, at the very least as a risk management process, but increasingly as also as an opportunity space for private equity. So across all these forms of capital, whether public or private, we see an increasing interest as an integration into valuations and in some cases a sophisticated understanding of sustainability initiatives. That's also evidenced, by the way, exactly because of the demand that we see from the investor community towards sustainability ratings, rankings, and data, which would be kind of expected given the proliferation of these information intermediaries that we have observed in the markets.